we look to Nvidia next week, obviously there has been a lot of chatter around, in particular, its sales into China of the H20 chips, the more advanced chips, which have now been blocked. Where is Nvidia going to need to sort of show growth here? What are investors going to be watching as we see that potential shortfall?
Yeah, so with the quarter they're reporting, those H20 sales actually were running ahead of plan until we saw the government block them, I believe. And added to that, Nvidia had some problems with Blackwell heading into the quarter. I think those really got smoothed out as the quarter progressed. And so my sense is with Q1, those better pieces, the better sales into China, at least initially, better shipments of Blackwell, that's really going to offset any loss of China sales in that last month. Where there's some impact is on the guide. So generally it's thought that the China piece is maybe 10% of the data center revenue. So let's call it 4 billion-ish. I think their consensus has started to take down estimates a little bit. But at the same time, with Blackwell getting better, with these new sovereign deals coming in, I think there's less concern moving forward than there was 2-3 weeks ago, because there's all these other new revenue sources that are popping up.
You know, to start the year, Matt, it was interesting. The stock was struggling. There's different reasons for that. One reason was DeepSeek, and NVIDIA executives addressed that. In your opinion, did they address that concern to your satisfaction, Matt? Do you think that concern is in the rearview mirror?
I certainly think it's in the rearview mirror, Josh. So if you look at what actually happened with DeepSeek, so predominantly a China phenomenon, DeepSeek was driving significantly more demand than expected for AI servers in China. And so I think at the end of the day, what you saw from DeepSeek was it was good news for NVIDIA. It was more demand. So I think that concern is certainly behind them.
It's time to present the evidence that NVIDIA is the clear poster child of the AI boom. Expectations are high when the $3.3 trillion chipmaker reports its fiscal first quarter earnings for 2026 on Wednesday. Analysts predict that adjusted profits per share will increase by almost 44%, from $0.61 to $0.88, and that revenue will soar to $43.26 billion, over 66% higher than the same quarter last year. However, the semiconductor giant may be undervalued based on such projections. Over the past 2 quarters, the company has exceeded earnings predictions by an average of almost 7%, demonstrating its propensity of exceeding expectations. NVIDIA has had an incredible run, with its chips serving as the foundation of contemporary artificial intelligence. With the stakes so high, however, investors are concentrating intently on whether NVIDIA's most recent investments, including its next-generation Blackwell platform, expanding cloud alliances, and response to U.S.-China chip tensions, will provide the kind of record-breaking quarter that the markets have been accustomed to. The data center business, which is the backbone of NVIDIA's revenue machine, has expanded into its largest and most lucrative area as a result of unquenchable demand from cloud providers, AI startups, and enterprise clients creating foundation models. Analysts predict that Q1 revenue from this business alone will total $21.27 billion. NVIDIA has been positioned by CEO Jensen Huang as the infrastructural layer driving the AI revolution, rather than merely as a chipmaker. With Blackwell, a GPU architecture unveiled in March that Huang claims will enable the training and deployment of models orders of magnitude more potent than existing systems, the company hopes that story will continue. Amazon Web Services, Google Cloud, Microsoft Azure, and Oracle are among the hyperscalers that have already incorporated the flagship GB200 Grace Blackwell superchip. Despite its dominance, NVIDIA is not working in a vacuum. Companies like Google, Amazon, and Microsoft are increasing their investments in proprietary silicon to lessen their dependency on third-party GPUs, while rival chipmakers like AMD and Intel are vying for market share. As NVIDIA struggles with export limitations, a wave of Chinese AI chipmakers is also starting to appear, putting additional pressure on the company to compete in one of its most significant regions. However, NVIDIA is now more than simply GPUs. In an effort to become the full-stack backbone of AI infrastructure, the firm is subtly expanding its AI stack as investor expectations rise. This includes pushing beyond silicon into networking, software, and cloud integration. In order to reduce profit volatility over time, Nvidia is strengthening its economic moat and generating more reliable, consistent revenue sources. Nvidia is integrating itself into the very systems that AI developers depend on by forming alliances with significant cloud service providers. In essence, Nvidia is working to expand beyond providing AI technologies. The company's goal is to become a key platform for the advancement of AI. Investors will be intently observing for unambiguous proof that Nvidia's foray into markets other than GPUs is beginning to generate profits. Wall Street wants to know if the company's networking products are helping the data center market grow significantly. Another major area of concentration will be margins. Any indications of margin expansion would lend credence to the idea that Nvidia is evolving into a more robust, high-margin platform company, as networking and software are generally more profitable than hardware, which might reassure investors that Nvidia's growth is steady and not just dependent on fluctuations in the demand for chips. Lastly, Wall Street will keep an eye out for indications that Nvidia's AI software stack is being adopted by big businesses outside of the hyperscaler ecosystem, such as in industries like manufacturing, healthcare, and finance. This would demonstrate the platform strategy's long-term potential and reaffirm Nvidia's position as the industry leader in AI development. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now let's get back to the video.
Matt, one of the other reports related to NVIDIA that we got today came courtesy of the Financial Times, which said Oracle was planning to spend about $40 billion on NVIDIA's GB200 chips to power OpenAI's new data center. I don't know if this is a surprise, because if they were building the data center, it was likely they were going to get NVIDIA's chips. But it does speak to the reliance of NVIDIA on spending from the hyperscalers. So what can we expect in terms of cadence with that spending?
Yeah, so you saw earlier Crusoe also announce that they've secured funding to build out those facilities. So, and I think when you look at the news from the Financial Times, let's assume it's accurate, they're talking about GB200 chips. So the current generation of product, that tells you that's going to come earlier. Let's call it in the next 2, 3, 4 quarters. And so from a cadence perspective, Julie, I think if it doesn't show up in Q2 for NVIDIA, it shows up in Q3, Q4, because when you get beyond Q4, you really start to see GB300, the next iteration of chip, becoming the larger portion of volume out of NVIDIA.
Matt, another big question, of course, top mind for NVIDIA investors was the AI boom and whether big tech would continue to invest so much in that boom. You heard those last earnings reports, Matt, from Meta and Microsoft and Alphabet, and when they talked about their CapEx guides, they remain confident. I'm just curious, when you look past 2025, Matt, you try to look in 2026, what do you see AI spending looking like from the hyperscalers?
Yeah, so it's hard to peg how much hyperscale growth there will be in 2026, and that's always kind of been the question, right? Can we continue to see the large clouds grow their spend like we've seen the last few years? The difference this time, I think, and I think your prior guest talked to this, we have all this incremental additional spend coming from these projects that are outside the hyperscalers. So in particular, the sovereign deals we've got, both Saudi Arabia and the UAE, and remember that I believe it was a UAE number in terms of chips. That was larger than the amount of product that Oracle is supposedly buying. So these large deals are really additive, and I don't see the clouds stepping away. The last thing I'd add there is, so one of the concerns has simply been that applications aren't going to show up. I think when you see OpenAI go out and spend the significant amount of money they did on Johnny Ive's new startup, that tells you that there are edge products that are getting close to being ready. And I think those edge products are going to be AI driven. And again, at the end of the day, that ends up creating growth for AI silicon like Nvidia produces.
According to BBVA strategists, investors have over $7 trillion in cash holdings, so a positive earnings report from Nvidia would be encouraging for a surge in U.S. stocks. According to strategist Michalis Onisiferou, institutional positioning in the U.S. technology sector is undemanding, with hedge funds and mutual funds being significantly underweight. While volatility control funds have ample opportunity to increase risk, trend-following commodity trading advisors, CTA, exposure to the whole stock market is likewise neutral, he noted. According to Onisiferou, the arrangement encourages greater stock exposure because the institutional length in equities is far from exuberant levels. Concerns about the fiscal imbalance and a revival of tariff hostilities caused the S&P 500 to drop last week after rising from an April low on hopes of reducing trade tensions. Since Nvidia's $3.2 trillion stock is regarded as a barometer for demand for artificial intelligence, all eyes are on the company's first quarter earnings report, which is coming on Wednesday. Even while Nvidia's stock has increased by around 40% over the last 7 weeks, it is still 14% off its record high from January. According to data gathered by Bloomberg, it trades far below its 5-year average valuation of 40, with a price-to-earnings ratio of roughly 28. Onisiferou cautioned, however, that the recent gain had left the stock close to overbought levels, indicating a difficult environment for the results announcement. According to the expert, demand from retail purchasers, who have been buying falls in U.S. stocks this year, also momentarily declined before being rekindled by Moody's Ratings debt rating. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now let's dive into today's video.
Just set the stage for us, because of course there's so much hype around artificial intelligence, and the two things sort of go hand in hand. You need the data centers to train a lot of these models. How do you see AI impacting data center infrastructure in the coming years?
Yeah, no, good question. But I think if you take a step back, you have to look at the whole demand for cloud storage to start with, and then how AI is having an impact on further increasing it. Just while we were waiting backstage, I was just looking at the history of clouds. In 2004, the word cloud storage did not exist. Smartphone maximum memory was 5 gigabytes, now it's 100 gigabytes. And just the amount of data storage created by the smartphones that we all have now is 246 billion gigabytes. Add to that Netflix, Amazon, Spotify, Teams, WhatsApp, Zoom, and and the fintech demand, and you are at 3 trillion gigabytes. Add to that artificial intelligence now, the language learning models that you mentioned, and that's supposed to be 50% of cloud storage demand in the next few years. So from our perspective, AI is, yes, enhancing the demand side, but as QIA, we've been investing in data centers for the last 10 years. What we are focused is not so much on the demand side, we are focused more on the capacity side, the supply side, that do we have the capability and do we have the right partners to deliver these data centers that are required, both for hyperscale cloud storage and also for AI. And there are various challenges around that.
I'm going to come back to that point. Doug, I'd like to move on to you. You recently announced an expansion of your global data centers division, land across pretty much everywhere, from what I can tell, North America, Europe, Asia. So it sounds like you see very strong demand as well, but not specific to any region, everywhere.
Yeah, so we look at everything from a global perspective, and we believe that there's going to be growth all across the globe. Right now, we're seeing strong demand signals for the last couple of years in the US. Europe's been constrained because of power availability. Some of the same issues exist within Asia. And so we have a team of people that have literally scoured the earth to find 10 plus properties, a little over 2 gigawatts of building load capable in those properties to build out. Because what we're seeing as a company is our pipeline has swelled over 25% year over year. We are seeing tremendous offtake from both enterprise and cloud, as well as AI. And if you look at the stats on AI and the projected growth rates, Jensen Huang talks about his belief that AI, will contribute to it'll be necessary to contribute over $1 trillion worth of data centers over the next 4 years just to meet the AI demand. And to put that in perspective, it's taken 15 years in the cloud environment to hit that $1 trillion data center number. So it's about 4x what you're looking at for AI. So we're extremely bullish on the global platform, and we're seeing different areas of the globe that we're investing in for different reasons. In the US, India, it's mostly hyperscale, and that's where we're seeing most of our absorption, most of our offtake. Within Europe, there's a fair amount of retail and enterprise, and within Asia, we're seeing a tremendous amount of enterprise, and we're starting to see some very large takedowns for AI and cloud. And so the properties we've purchased over the last year have been Milan, Frankfurt, Hillsboro, Oregon, several in Tokyo. We've purchased all across, so we're starting production on those, and frankly, on about half of those properties, before we even put a shovel in the ground, we've already leased the properties out either partially or completely. Wow. So we're extremely bullish on the outlook of the industry. If you just go back a year ago, 2 years ago, the CAGR was 13.5%. The projected CAGR now is 23%. So, there's not a lot of industries growing at that rate, and we're very bullish.
Yeah.
China is undoubtedly a significant X factor. In the US-China tech competition, Nvidia is at the forefront. Its GPUs may be the most valuable parts of the AI arms race, and policy, not just engineering, is increasingly determining its position. A significant portion of Nvidia's revenue has historically come from the Chinese market, but this has drastically shifted in the aftermath of stricter US export regulations and tariffs. Hung recently said that years of American limitations on the export of AI chips were a strategic blunder that lost Nvidia billions of dollars and gave Chinese competitors a strong incentive to develop. According to Huang, Nvidia, which at the beginning of the Biden administration had a nearly 95% market share in China, is now only in control of 50% of the market. Nvidia is apparently working on more reduced chip models that adhere to US regulations in an effort to strengthen and maintain its position. The company also plans to open an R&D unit in Shanghai. Investors will be watching to see how US export restrictions have affected sales, if downgraded chips can continue to meet Chinese demand, and other factors. Since Nvidia depends mostly on TSMC for manufacturing, its capacity limitations continue to be a gating concern. Thus, Wall Street will also be keeping an eye out for any supply chain stress. Wall Street will be watching for updates on how Nvidia intends to handle what may be its most difficult international environment in years, even though the company is still dominant in many global markets and is entering the Middle East through Saudi Arabia and the United Arab Emirates in what one analyst called a watershed moment. The financial performance of Nvidia, the AI industry's poster child, is a high-frequency measure of how far the generative AI economy has advanced from hype to tangible profits. Reaffirming the AI investing thesis that has primarily driven the Nasdaq's advance, a big beat would indicate that tech titans like Microsoft, Google, and Amazon are continue to pour billions into AI infrastructure. Nvidia has a high valuation, but so do many other companies with ties to AI. High-growth companies' present risk appetite may be justified if Nvidia fulfills or exceeds forecasts. However, even a small error could cause a reset in mood. Strong forward guidance will demonstrate that businesses are beginning to invest in AI outside of tests, such as in software integration, inference, and LLM implementation. In 2025, Nvidia's stock has experienced a significant upswing. Shares dropped after reaching a peak earlier in the year due to general market volatility and investor concerns about whether the AI trade had reached a fever pitch. The stock fell precipitously after President Donald Trump's April 2nd Liberation Day declaration, but it has since recovered. The outcomes of this quarter, however, might be a turning point that restores momentum. The capacity of the supply chain is one pressing issue. Demand for Nvidia's chips is still higher than supply, and even while the firm has made efforts to increase production, the length of time it takes to produce and deliver its most cutting-edge products may still be costing it money. Details regarding supply chain resilience and capital expenditures will also be actively monitored by investors. Wall Street will be interested in how quickly Nvidia is investing to increase capacity, whether that means acquiring more vital components or forming new relationships with foundries. The appearance of sustainable present growth trajectories may be impacted by any indications that supply constraints are lessening or getting worse. However, the key question at hand is whether Nvidia can continually meet and surpass expectations. The pressure is higher than ever, even if Nvidia is still perhaps the most significant business in the most exciting tech industry in the world. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
We're very bullish.
Yeah. The numbers are huge, though. $1 trillion is a chart up there. $230 billion, some of the big spenders last year, those 5 that are listed. Mark, let me ask you, there is a lot of money going into this space. There's skeptics out there. They're nervous about there potentially being a capital glut and for all of this to come crashing down. Are we setting up for another bubble? Is this going to be another dot-com bubble in the space?
Yeah, look, to contextualize it, I think that we're in a very different environment from a demand perspective. I think you saw a lot of speculation in the dot-com era where people laid fiber cabling with no customers on the other end of those cables. I think what's interesting, having been in the sector for 30 years and having watched some of these cycles, what is different about this cycle is we don't have a demand problem. We have plenty of customers that require compute. We certainly don't have a lack of land, and we certainly don't have a lack of capital. What we do have is a lack of power, and we can certainly drill down into that. But on the capital side, it's actually interesting. I think most of the allocators globally, and Navid, you could vouch for this, I think investors have put a lot of capital to work in data centers, particularly in infrastructure funds. And a lot of these platforms that they've developed have reached a level of $10, $15, $20 billion. And ultimately, LPs are saying the same thing, which is, okay, this has been great. We've enjoyed riding this AI wave, but at some point we need capital back. How do we create DPI? And how do you recycle capital? Investors obviously want to invest in great ideas in AI. They want to be exposed to investment-grade leases. But at the end of the day, we do have an obligation as a GP to return capital and to create returns. So one of the things that I hear most recently in the last sort of 6 months of fundraising is, what are you doing for us in terms of returning capital? By the way, it was the same thing that happened in cell towers in the late 90s. It happened in fiber in the early 2000s. It happened, Doug, with cloud computing in the last 10 to 15 years. People want that capital back. And I think ultimately it's about where you sit in the capital structure. And if you think about the progression of how digital infrastructure has been built, it started almost as venture capital. It migrated to private equity. And then ultimately it now sits with infrastructure funds. And now there's the next leg that's going to play out, which is 90 to 120 billion of stabilized data centers that ultimately has to be in real estate vehicles, whether it's a publicly traded S-REIT, or if it's a continuation fund, or if it's really insurance capital that's coming into the sector for the first time. There is going to be a recycling of capital that is going to happen. And we're at that moment right now.
Would you say there is a funding gap, though, given the needs and given your projections?
I don't think there's a funding gap. I mean, we put out about 26 billion of CapEx last year just at DigitalBridge alone. We have another 19 billion that's funded this year. And I think the way that we're funding those assets today are perhaps a little bit different from how we funded it 3 years ago. I think certainly the financing market has matured. We're talking about equity. We haven't even begun to talk about debt. I think the way these assets are now being deployed in the securitization market and the depth of that securitization market, particularly through investment grade, is about as deep as you've ever seen it. Just in the last 30 days alone, we had 6 data center securitizations that got launched and closed across many different platforms, across many different GPs. If you aggregate all of that securitized capital, which is predominantly insurance companies or opportunistic debt investors, there was close to almost $12 billion of securitized paper that's traded hands in digital infrastructure in the last 30 days. So there's a coming of age of this asset class that I think is really interesting. I've gotten to watch it because I started in the early 90s when I was backed by family offices and venture capital. And now today we're an infrastructure fund. But I think this progression of capital is really important. And I think the movement of capital and the maturation of the debt markets for digital infrastructure is something that's really important. So we don't have a funding gap as long as capital keeps moving. Capital has to keep moving in this market.
Yeah.